But the high level overview is that yes, these expenses paid are deductible. The loan, if forgiven, is not taxable income. So really no tax impact necessarily, maybe a timing issue, on the borrower of these funds. And that holds true both for PPP round 1 and PPP round 2. Same rule set applies there. So with that, let's dive into some of these details specifically. So SBA issued the interim guidance last Wednesday after our program, unfortunately. But it specifically talked about there's three rule sets they issued. We're going to talk about 2 of them. One rule set was taking all of the guidance that they had issued on round 1 programs, consolidating that, updating it for changes that came due to the Stimulus Act, and putting out a new set of round 1 guidance. And then the second rule set that's important to us is they also issued a second draw loan requirement. So we have guidance on both that we'll talk through. Timing, this is probably everybody's big question, and this is pretty hot off the press. The PPP portals actually did start opening this last Monday, the 11th. However, that was only for a very, very small subset of borrowers. So community development financial institutions, minority deposit institutions, and certified development companies, and some microloan stuff. This was related to the fact that Congress felt the first round of PPP loan borrowers did not, help some of the smallest, neediest, parts of the business community. And so they set it up so where the second round program would start with those borrowers first being eligible to get into the program. So since Monday, the borrowers working with those types of institutions have been able to start, applying for PPPs loans. Now, I haven't actually seen any information about how much has been, earmarked yet out of the $284 billion that this program has, but I expect we'll start getting some of those numbers from the SBA, over the next coming days or weeks. So PPP loan portals have been open for them. PPP loans will start opening tomorrow, Friday the 15th, for borrowers who work with, smaller lending institutions. So those lending institutions who have $1 billion or less in lendable assets. That's going to be a very, very small subset of banks, who are able to start processing PPP loan applications tomorrow. For the vast majority of lenders, for the vast majority of people on this call, the date to know is next Tuesday. Next Tuesday is when PPP portals are going to open up for the traditional and fintech lenders who have assets in excess of $1 billion to lend. So next Tuesday is when the portals are expected to be open. And of course, the last day to apply to this program right now is March 31st, 2021. Could they extend that? Who knows? Will the funds last till then? Once again, who knows? I would encourage you, if you're considering taking a second round PPP or a first time borrower, requesting the increase to your PPP loan funds, you're probably going to want to, get that application in sooner rather than later. Now, I do see some questions coming through from the audience. I do want to let you know that we scheduled this webinar for an hour and a half, and I expect my presentation will last about an hour. So if I haven't got to your question during the course of the presentation, just hold tight. That last half hour of time is going to be somewhat dedicated to going through the questions that have come up, because I know there will be quite a few questions. So we will first get through the entire presentation, probably take a short 3-4 minute break so that I can kind of read through all the questions that have come through, and then spend the last 20-25 minutes going through those questions and some of the answers I would have to them. All right, so as it relates to first round eligibility, the eligibility rules for the first round remain the same, other than for a very few changes related to some ineligible businesses that we'll get to a little bit later on. But essentially, the first loan eligibility is you have to be a small business, nonprofit, veteran organization, or tribal business with 500 employees or less. And this includes self-employed individuals. So no change from the guidance that was issued back in April, so getting really close to a year ago now, of who could take a PPP loan. Those businesses to be eligible for a PPP loan must have been operational as of February 15th, 2020. Now you say, hey, that's wonderful. You know, fortunately, I have a client who missed this deadline by 3 days. 3 days. He started, had his business license applied for, had everything up and going on the 18th of February. So he would have been eligible for this program other than he missed it by a 3-day window. So that deadline is hard in the sand. No getting around it. If your business wasn't up and running on the 15th of February, you cannot participate in these programs. And then finally, the loan must be necessary. And that's kind of a little bit of a wishy-washy area. We'll talk about that a little bit more when we get down to the bottom of second eligibility requirements. So what you see in there is that this is really just the exact same guidance we had from the first go around. So if you did not get a first round loan and you were eligible, you are okay to go in and apply for one. Now, second draw eligibility is a little bit more stricter. And this is one of the big enhancements that came through the stimulus bill, was to say, we are going to allow businesses who took out a first round PPP loan to apply for a second PPP loan if they meet certain criteria. And here's the criteria at a high level. We'll have a few more slides to walk through the details, because this is probably where there's going to be some questions at. So second draw eligibility, you can only take a PPP loan, second draw loan, if you have no more than 300 employees. So that's down from the 500 employee limit of before. And this includes looking at affiliate rules. So, if you're a business concern and you have ownership or some sort of management control, with some other outside, businesses, you may have to look at these affiliate rules to say, one, do I meet some of the gross receipts tests we'll talk about? Do I meet the employee tests, et cetera? Those affiliate rules can be pretty complex. There's some very bright line things around percentage of control, et cetera. But then there's some very, not bright line areas around, management, affiliation, things like that. So if your business is going to potentially fall into a category where you might have some affiliate rules, that's going to be something we're going to want to take a deep dive into, probably with your accountant, looking at the guidance, maybe even with your lawyer, to understand, am I eligible or not based on the affiliation rules? The second criteria, besides the employee, is you're going to have a demonstrated 25% or more reduction in gross receipts in any calendar quarter of 2020 as compared to the same calendar quarter in 2019. So there's 4 calendar quarters. Right now, we define it as what you think of a normal calendar quarter, January through March, Q1, April through June, Q2, July through September, Q3, October through December, Q4. That is the definition we have now. Now, there could be guidance that gets issued from the SBA saying you can use a fiscal quarter basis, but that has not been issued yet. That has not been confirmed that's to be the case. So right now, if you're looking at a PPP loan, start looking at the calendar quarters 2020 compared to 2019. Now, you only have to qualify on one calendar quarter. So if Q1 2020 to 2019 is break even, Q2 to 2020 to 2019 is maybe even up a little bit, but Q3, you see a 30% reduction in revenue from quarter 3 2020 compared back to 2019, you qualify. So it is not a whole year. You don't have to meet every calendar quarter. You just have to meet one. Now, they did provide some additional guidance in these interim rules, which said, hey, if you're a small borrower who essentially may not have good quarterly financial information, you can also look to see if your entire 2020 had a more than 25% reduction in gross receipts compared to 2019. And if that's the case, you're still eligible because mathematically, you had to have had more than one quarter that was a more than 25% reduction in gross receipts. So if you do not have good quarterly data, you can rely on annual information. But for most people, you're going to be able to look at your quarterly information do those comparisons to see if you qualify. Another eligibility test for second draw PPP loans is you have to have received and used the full amount of your first PPP loan on eligible expenses. And so what that means is second draw PPP loans are only for those borrowers who have already got their first round PPP loan and spent it down on eligible expenses. We'll talk about a whole host of issues related to that as we get into some of these other things where it correlates to, do I want to try to increase my first round PPP loan? What are my eligible expenses, etc. But really, second draw loans are for those borrowers who got first draw and spent them all down. Once again, the loan has to be necessary. Let's talk about necessity a little bit. Necessity is not well defined. The SBA has essentially issued no real firm guidance on what necessity means. So I've heard various comments from different commentators around necessity. Do I need to try to prove that I have some impacts currently in my business? Do I need to prove that I have some future impacts? And I've heard some commentators say you need to be ready to prove all of this. I've heard other commentators say, well, no, because nobody can really foresee what the future is. I mean, quite honestly, it's hard to project. Could the impacts of what COVID has done to my business this year, affect me in the future? Well, I think everybody could say there's probably a possibility that could happen. And so the necessity question is a very unusual one because it's not defined. I still continue to go back to the SBA safe harbor guidance they issued in May of last year, in which they specifically called out again in these interim rules. And that to me is the biggest thing we can rely on because it's actually written down and they provided it to us. And that is, if your loans are under $2 million, necessity is automatically deemed to have been there. That to me kind of leads to the thought process that if it's under $2 million, we can assume necessity. Now, I'm not a lawyer. I can't counsel you that that's, going to hold water, but that's what the SBA has given us at this point. For those borrowers who exceeded $2 million, they've had, and I've worked with clients that have had that. And when they've come to do their forgiveness application, there's a huge SBA questionnaire form they have to fill out where the SBA is really trying to assess necessity. So, my counsel is if your loan is in excess of $2 million, you're going to really need to start putting together the thought process around necessity, because the SBA has already started looking at that through the questionnaires that they provide people when they apply for loan forgiveness. Now, that shouldn't discourage you from looking at these PPP loans, but it should give you an extra pause to say, do I need these funds or not? Now, the cap on the PPP round 2 loans is $2 million. But, the other thing that we've read in the interpretation is that the total of your first and second round drafts cannot exceed, the $10 million that they put into the initial legislation. So, if you received the $8.5 million first round PPP loan, my understanding reading the guidance and the regulations is you could not get a second round draw if you were eligible for it that exceeded, the difference, or 1.5 million. So you wouldn't get the full $2 million cap. But what that also means, the inverse of that is to say, if you are a first round borrower who say got $1.8 million, you could still go get a second round loan of potentially up to $2 million because you're still under the total $10 million cap. So first and second round loans can exceed 10 million, but that doesn't necessarily mean the $2 million cap only applies to your second draft PPP loans. Now let's talk about the PPP first loan increases a little bit, and then we'll dive back into some of the more details around that second draw eligibility. I wanted to hit these kind of three different paths to PPP loans first, and then we'll dive into the details around second round eligibility a bit. So first round PPP loan increases. If you received PPP loan funds and subsequent rules change to say I would have got potentially a bigger loan, then you can go back and request the difference. And that's going to be part of the application process that banks have, starting next week or Friday if you work with, a smaller institution. So some really good examples. If your business falls in these categories, this is something you're probably going to want to go back and look at closely. If you were partners in a partnership who went and got into the program right away before the rules around how partners claim, PPP loan compensation funds, there's a high likelihood you did not get as big a loan as you were eligible for, and you may want to consider it. If you're a farmer and rancher, the new SBA rules that we'll talk about here in a little bit definitely mean you're going to want to go back and look at this. If you are a self-employed individual with employees who got in early, just like those partners in a partnership, the guidance may not have been there yet to say, how do I claim my own compensation replacement? So they may want to look at one. If you were a seasonal employer, those rules changed quite a bit. And so you may want to go back and rerun the payroll numbers based on guidance that was issued after the fact to say, could I have gotten a bigger loan? And finally, if you are a borrower who got it early on, got scared around some of the necessity requirements, et cetera, before the SBA issued that safe harbor, and you returned some or all of your PPP loan, you can go back and actually request that now if you feel like the necessity is there and you're still eligible for it. Same thing with somebody who may have, gotten approved for a $200,000 PPP loan, but only decided to take $100,000, they can go back and request the difference as well. And you're saying, well, why would you have accepted less of a PPP loan? Well, remember when the PPP loans were first initially issued, it was 2.5 months payroll costs, but we only had 8 weeks to spend it. So some people who, especially if your business was shut down, were looking at it saying, I'm not maybe going to be able to spend all of this in time. I only want to take the amount that's going to be forgiven, so I'm going to give some of the money back, or I'm not going to take it in the first place. And so if you're one of those borrowers who caught in kind of the initial, round of, hey, getting the funds, but not having clear guidance about it, you may have not gotten as big of funds, you may have returned some. Now you can go back and potentially recover those. Now, if you remember on the last slide, I did talk about second draw borrowers are eligible borrowers who got their first round proceeds, spent it all down on eligible expenses, and then got second round proceeds. So the question is going to come up, what if I am both eligible for increasing my first round PPP loan and I'm eligible for a second round? Well, that's a tough question. I don't have a great answer for you. I'm going to give you my perspective right now. There's no final SBA guidance on this, but it doesn't seem like anything precludes us from increasing our first round PPP loan funds and potentially qualifying for second round of PPP loan funds. But remember that qualification factor on the second round is you have to have spent down your entire first round loan. So the way I read that is if you increase your first round loans, you have to spend those down. And after that period of time, then maybe you can apply for a second draw if you are eligible. Who knows how long this program is going to last? So if I'm counseling a client, I'm taking a look to say, if I'm eligible for a first round increase and I'm eligible for the second draw loans, what's the difference? Is my first round increase $10,000 and my second draft loan $200,000? I probably don't want to play a timing game. I'm just going to go after the second round loan. I'm not going to worry about the first round increase. Potentially you could get the first round increase, spend it down, go get a second round increase. I haven't seen anything to preclude us from doing that yet. Not to say the SBA could issue guidance for precluding us from doing that, but I'm really counseling clients to look very closely at first round increases versus second round eligibility, which one's more beneficial to your business, and probably go down that path. All right, now we'll talk about the true burning question of the day, not my haircut, and that is, okay, let's get into the nitty-gritty details around second draw PPP loans and those eligibility requirements. And so the biggest change besides the employee cap on second draw loans was the gross receipts test. We have to prove that 25% reduction in revenue between any quarter in 2020 compared to that same quarter back in 2019. So what is gross receipts? Well, they didn't necessarily specifically define it in the guidance, but they did refer back to prior SBA guidance. So they gave us a pretty good guideline to use, but they also left it pretty wide open. So I'm going to encourage you, you're going to want to look at this a couple different ways. So gross receipts is defined as all revenue in whatever form you receive or accrue it in accordance with your accounting method, how you track your books and records from whatever source, including this list down here, right? So that includes the sale of products or services, though I don't have to include my returns or allowances, interest and dividends my business earns, rents and royalties that come in, fees and commissions, and I have to look at it across any of my affiliated entities. Now, a couple things there. Let's go back up to what I have highlighted in bold on the slide. Entities accounting method. Yeah, this is where we're spending a little bit of time with clients looking at this, because many of my clients will track their books and records on a accrual basis, right? So they are accounting for income and expenses as they are incurred, not necessarily paid out, but as they're incurred. When I invoice a customer, even though that customer hasn't paid me yet, that's revenue on my books. When I get a bill to pay, that's an expense, even if I haven't necessarily paid it yet. Now, the vast majority of people on this call may track their accounting records internally on an accrual basis. When it comes to filing your tax return, there's a good chance you're a cash basis taxpayer because of the flexibility that it provides. So which is my accounting method? Well, my argument, since the SBA did not clearly define this, and the argument I've heard from every other commentator out there, is that you have your choice. If you track your books and records on both a cash and accrual basis, you can use whichever one gives you the best answer. And I've seen that. I've seen it where, maybe on an accrual basis, my Q2 revenue was only down 23%, so I don't qualify. But if you flip it around and look at it on a cash basis, I'm down 35%, and I do qualify. And I would argue you could use whichever method gave you the right answer there. And just think about that honestly. What happened in Q2? Coronavirus hit. Businesses had a lot of uncertainty. A lot of business had closed down. So even if you were shipping product out, maybe now you weren't getting paid on it. You had a true reduction in revenue, right, on a cash basis, even if you had invoiced and were on an accrual basis. So I'm encouraging clients, if you track your books on both bases, you're going to want to look at both for figuring out which provides that 25% reduction in gross receipts in any one quarter. Now, the guidance did also specifically exclude some items from what's gross receipts or what's income. And those things that it specifically excluded were PPP and EIDL loans. Whether forgiven or not, you don't have to include that in the totals. It excludes net capital gains or losses. So, if like one of my clients, you sold, a trademark for your business, that's a net capital gain. That is not going to be includable in these gross receipts tests. It doesn't include any taxes you're collecting or remitting to taxing authorities, biggest example being sales tax. So whatever I collect as sales tax from customers, that's not an item of gross receipt for my business. It does exclude intercompany transactions, transactions with your affiliates. So, we do have to include the gross receipts looking across all our affiliate base, but not the stuff that's occurring between us. And then finally, it excludes, amounts that were collected from on behalf of another by a travel agent, real estate agent, advertising agent, conference management services, freight forwarder, customer broker. Basically, it's saying, hey, if these things are really just, hey, I'm collecting on behalf of the customer to pass through, that's not gross receipts to me. But it's a very, very specifically defined, set of people there. So it's only my read of the regulations. It's only people in those specific, job descriptions down there that can qualify to exclude those types of gross receipts. So, if your business is taking money, let's say, your business is fronting some fees for a client and then paying them back out to somebody else, unless you're in this category that's listed on this slide, I think those are still gross receipts under this test. So you have to be very careful looking at that. So the gross receipts and that look back period is going to be very important. And that's what, starting last week with kind of the webinar we did on this, first round of stimulus, I've been really encouraging people, even though we didn't know when the portals were going to open up, even if we didn't know all these other eligibility rules, start looking at that. So if you haven't looked at that yet, please go back and look at that, because that's going to be the biggest qualifying factor for, are you eligible for a second draw loan? Now, remember, this is only for those second draw loans. The gross receipts test does not apply to first-time borrowers, does not apply to first-time borrowers requesting an increase in your loan. This only applies to second round borrowers. Okay, so what is the application process going to look like for the second draw loans? So I didn't put a slide in about the first round application process because it's essentially the exact same as it was before. But what's changed for a second draw borrower? Well, it kind of depends. If you decide to use if when you went and did your first draw PPP loan and you used your average payroll cost from 2019, and that's going to be what you use to determine your second draw loan, and you're planning to use the same lender, you do not have to resubmit payroll documents to support your payroll costs. So essentially, if I use 2019 payroll costs and I'm working with the same lender, I don't have to resubmit all that payroll substantiation documentation. And so essentially my loan is going to be the same amount as it was the first go around. Now, if I choose to use a different payroll coverage period, if I choose to use different lender, I'm going to have to go through that full rigmarole process like we did with first round loans, which was submitting average payroll costs information. And we are going to be talking about, what are those payroll costs here in a little bit. The big change for the second draw loans is going to be, what do I need to show on the revenue reduction documentation? The SBA provided very high level guidance. And once again, you got to remember, these PPP loan programs are actually through the banks, not through the SBA directly. The banks provide the PPP loans, the banks assess eligibility, and then they request the funds from the SBA. So it's going to be bank specific in terms of what they're requesting. And if we remember back to PPP round one, different banks had different ways of looking at the PPP loans and what were eligible payroll costs. I'm going to venture to guess that we'll have the same thing with round two in terms of the revenue. And like I said, we haven't really had an open portal yet. And so I don't know what banks are necessarily requesting, but here is what the SBA has put out as guidance. So this is going to be what the SBA has put out. Your bank could request something different than this. And you got to remember, it's your bank you're working with. So you're going to have to work with them on what is the documentation they need to show this revenue reduction. But from the SBA guidance, what they're saying is we just either need to see relevant tax forms, including annual tax returns if you're planning to use that, all of 2020 versus 2019 comparison. Or if those aren't available, which for many of us they're not. I mean, how many people have filed a 2020 tax return yet? Nobody. We can't even e-file them yet. So, we probably won't necessarily be using annual tax returns, except in some cases. More likely what you're going to be submitting to the bank is quarterly financial statements, internally generated financial statements that show the reduction in revenue, or potentially even just, the bank statements to say, hey, look at my 2019 quarter two deposits. Here's all my revenue that came through the bank. Look at my 2020 quarter two deposits. Here's all my revenue that came through the bank. You can see the reduction in 25% of gross receipts. I don't know how yet the banks will be facilitating this, but that's kind of the guidance the SBA has put out now. So that's going to be an important area to watch and see, and talk to your bank contact about what they're going to need. Now, for loans that are over $150,000, you're going to have to submit these revenue reduction documentation at the time you apply for the loan. So they are a required part of the application package. For those loans that are under $150,000, you don't have to actually submit them as part of the initial application, though I think there is a certification on the application to say we had a reduction in gross receipts. but you will be required to submit these documents at the time you apply for loan forgiveness. Well, that's great. However, you're going to want to make sure that you really had a 25% reduction in gross receipts. So more likely than not, you're going to have done all the work to figure that out anyway. So my counsel would be, you're probably just going to want to submit it, with the application, even if it's under $150,000. Now, why they put this in here is to say, okay, for those businesses who may not have good quarterly information, but clearly had a 25% reduction in receipts, that's when they can potentially use their 2020 tax return compared to their 2019 tax return to substantiate the reduction. And so if your business is really going to be reliant upon that annual tax return to supply the necessary revenue reduction qualification, and you're under that $150,000 threshold, then you can wait and use that when you submit for loan forgiveness rather than at the initial application process. So that's what the second draw loan process is starting to look like in terms of documentations. Like I said, portals are starting to open up either tomorrow or early next week. We'll see how the banks actually implement this in practice, because like we saw from the payroll side of it with first round, there was a wide variant in practice. Okay, so what were some of the changes related to ineligible? The first round of PPP loans, we actually had a much smaller group of what are ineligible businesses. The Stimulus Act did update and expand that list to, okay, there's more ineligible businesses than the first round of funds. Now, this expansion of ineligibility applies to any potential first round borrowers who are getting their first round of borrowing after December 27, 2020, the date of the stimulus bill. So if you were initially an eligible business, but you didn't take a PPP loan, and now you want to take one, well, you're out of luck. This ineligibility list applies to first-time borrowers, PPP loan increases, and second draw loans. So if you're on this list, it's pretty much a no-go, right? And why did they expand the list? Well, they dealt with the political fallout from some of the bad press that came from the first round loans, right? You had, publicly traded companies who were getting loans, and so they shut that door. You had, members of government and Congress who were getting loans. They shut that door. They added a new one to say, hey, if your business permanently closed in 2020, well, you're no longer eligible. If you permanently shut it down, you can't go after, additional PPP funds. Now, this business in bankruptcy, this is a sticky issue. I'm not sure how to address this one, because the first round of the PPP loan process did actually, on the application said, hey, if your business is in bankruptcy, you're ineligible. Well, guess what happened? That wasn't ever in the actual congressional bill. That was something that the SBA added on after the fact. And so it got challenged. It got challenged in bankruptcy court. If you had a client who was in bankruptcy, they took this in front of the judge, and there was multiple cases that bankruptcy clients won saying SBA is wrong, you should be eligible for a PPP loan. So, first round, businesses in bankruptcies, they kind of were told no, but some courts decided yes. And so some clients in bankruptcy did get PPP loan funds. SBA is doubling down on this round, saying, nope, if you're in bankruptcy, you cannot get these. Now, if I have a client who's in bankruptcy, I'm going to tell them, go talk to your lawyer, go potentially get this in front of the bankruptcy court judge, because what we saw in the first round was it got challenged successfully. Maybe we can do that with the second round. Not saying it's going to happen, but who knows, right? One of the other, businesses who engage in political and lobbying, they were eligible first round, no longer eligible. This is the Chinese influence, and these shuttered venue grants, which we talked about shuttered venue grants, last go around. So if you want to know more about those, go back to our last webinar. But for those small subset of people who qualify for a shuttered venue grant, those potentially are much better of a program, much stricter requirements, much less funds available, but potentially a lot more money coming to support the business than a PPP loan. So you have to really consider that one if you're going to be looking at those shuttered venue grants. Okay, let's dive back in and do a little bit of refresher on what are our payroll costs that are eligible for figuring out these PPP loans, and what are some of the changes that came in the stimulus bill in terms of how we look at payroll costs. So under the first round program, we were essentially using 2019 payroll costs. Well, under the second round program, whether you're a first time borrower, whether you are a second draw borrower, you're going to be able to use either 2019 average payroll costs, 2020 average payroll costs, or potentially the 12 months prior to the application for identifying your eligible payroll costs. So what would that mean? Well, maybe we could take February 1 of 2020 through January 31st of 2021 payroll costs, if that gave us the right answer. Now, what I'm just going to tell you in practice is that might be a very, very difficult thing to substantiate, because many lenders are wanting to see, your quarterly tax filings, etc. I'm counseling clients, you're probably really just wanting to compare 2019 and 2020. Which of those two gives us a higher average payroll cost to use for figuring out our PPP loan? And if it's a second draw loan and the difference is fairly minuscule, even if 2020 is better, I'm probably still saying go back and use 2019, since you don't have to resubmit all the documentation. But it's definitely something you want to look at, because there is the case where 2020, we could have been an essential business. We had a decline in revenue, but we still had increased payroll costs because of what COVID was requiring us to do in terms of employees to support the business. And so 2020 very well could lead to a better answer in terms of average payroll costs. So really do sit down and assess that. And if, depending on what payroll service you use, many payroll service providers, some of them sooner than others, understood that this was going to be a real, nightmare for people to figure out. And so they started actually building the reports into the payroll software, right? So, if you use Gusto, like I recommend a lot of my clients do, they have a very, very beautiful average payroll cost report. It takes about 2 minutes to run, and you've got your average payroll costs used for the year. QuickBooks, eventually put out a average payroll report. So, do look to your software, to say, do we have these reports available to support a calculation so we compare 19 to 20? Do realize they're only as good as the information you put in, right? So, if you aren't set up in your payroll system to be calculating the group insurance benefits correctly, or employer provided, whatever is an eligible payroll cost, you may not be getting the right answer from those reports. So you do need to assess the validity of the report, but they are a really wonderful starting point. And if you set up your software correctly, they can be the final answer of what is my average payroll cost. Okay, so we can use either 1920 or the 12 months prior for figuring out average payroll costs. For the next two categories I'm going to talk about, partners and self-employed individuals and farmers and ranchers, there's additional compensation we can look at. It's essentially owner's replacement compensation. And so for partners and self-employed individuals, essentially what you can do is look at either 2019 or 2020 net business profits as shown on your tax return. You take that capped at $100,000, per individual, whether it's, if you've got 3 partners, $100,000 per partner. If you're a self-employed person, a Schedule C business owner, well, it's going to just be you, so it's $100,000. So that's your cap on your net business profits. You can't go above that $100,000, but you essentially turn that into a monthly payroll figure. Divide that number by 12 to figure out what is my average monthly payroll cost that is owner's compensation replacement. And then take that times the 2.5 number we use for figuring out, how much payroll we're eligible for the loan for. And that is the owner's compensation replacement calculation. And so that's on top of, what you have been eligible for based on your actual employee costs. So this is for, 1065 partnerships, Schedule C businesses. If you are a C corporation, S corporation, your owners are already taking wages through the business. So they're inherently built into your average payroll cost calculations. So these are the additional calculations you have to go through for partners and self-employed individuals. So that's the calculation for those group of parties. Now that stuff was released back in kind of the interim period of guidance between April and June when the original PPP loan programs were on. So that's been around for a little bit now. This next category is actually brand new under the stimulus bill, specifically related to Schedule F farmers and ranchers. So if you are a farmer who is an S corporation, a partnership, C corporation, this rule set does not apply to you. This is only for Schedule F, essentially sole proprietorship farmers or single member LLC farmers. But if you fall into that category, rather than using a net business profit, net farm profit approach like we just talked about up above, instead you look at gross farm receipts. So you are looking at gross farm receipts rather than my net business profit to say, how much am I potentially eligible for as owner's compensation? So that gross receipt amount is still capped at $100,000. But you can use gross receipts, up to that $100,000, even if our final net profit for the farm was a negative number. So we get to include it based on revenue rather than profits. Now, for the gross receipts test, if you are a farmer who you're scheduled a farmer but has employees, you do have to reduce those gross receipts by the payroll costs that you're going to be claiming for your employees. So, if we've got $500,000 of gross farm receipts and $250,000 of payroll costs, it doesn't matter because we are still capped at only $100,000 of our farm receipts anyways. But if we are a farmer who has $150,000 of gross farm receipts and $100,000 of payroll costs, then we have to take our gross farm receipts number down to $50,000. We have to subtract out the payroll costs before we figure that out. But then it's the same calculation. We divide by 12 times 2.5. That's the number we get as farm owners compensation. And this was a brand new rule that they said retroactively applies to first round PPP loans. So for a farmer, a Schedule F farmer, you're definitely looking at this to say, okay, should I go increase my first round PPP loan? Or am I eligible for a second round PPP loan, and which one's going to give me the better answer? I really have to look closely at that. But when you apply for your second round loan, this calculation goes into that second round loan. So owner's compensation is a big part of what that second round draw could be. Seasonal employers have their own special calculation. For the PPP round 2 program, it's defined as any 12-week period of payroll between February 15th, 2019 and February 15th, 2020. So you can find the 12-week period during that year time frame where you had the highest average payroll costs, and that's what you can use for figuring out what my average payroll cost is for a PPP loan. And this is for the second draw borrowers on farm for seasonal employees. Now, seasonal employees have a very specific definition. So seasonal employees are any employer that doesn't have more than 7 months of operations in the calendar year. So if I'm a Christmas tree farm that operates for a couple months, well, I guess that's probably a bad example because I have to have my employees out there. But if I'm a highly seasonal business, let's say I'm a raft guide business, right? My business really only occurs from about July through maybe October, right? Okay, I am a seasonal employer. I can use the seasonal calculation for payroll costs. Or your second definition, this is probably what helps a lot more people, is to say, if I had gross receipts in a 6-month period during that year, which were only a third of my entire gross receipts, then that also by definition means I'm a seasonal employer. So essentially saying, hey, if I'm a seasonal employer, I probably have payroll costs that are very specifically allocated or really high during a certain part of the year, and so I should get a better PPP loan calculation. And then finally, the last big change from how we look at payroll costs specifically relates to those food service and accommodation industries. So this is anybody who has a NAICS code in the 72 range, and there's an appendix later on that you can see when you get the slide deck of what specifically is that. But those borrowers are eligible for using a 3.5 times average payroll cost number rather than a 2.5 times. And that applies whether you're going to be drafting a first-time borrower or a second-round loan. You can use that 3.5 times number for figuring out what my average payroll costs to use are. All right, so what are those eligible payroll costs that we get to include for figuring out, what our loan's going to be and, what are allowable expenses? And so here's kind of the rundown of those. I'm not going to read through everyone in detail, but I'll hit the high points, right? We have to have people who live in the US, not outside the US, right? It's pretty much any item of pay unless it's salary that's over $100,000. So we only get to include the first $100,000 of salary for people. If you have people who are paid 150, you only get their first 100,000. You can't use their second 50,000 in figuring out what your eligible payroll costs are. It does include any type of paid leave, as long as that paid leave wasn't under the FFCRA, so the Families First Coronavirus Act. So the Family First Coronavirus Act, mandated emergency sick pay, mandated emergency family leave, but the employer got a tax credit to offset any of those costs of wages. So if you used payroll, if you had payroll costs that you got the FFCRA credit for, those are excluded from what you figure out your PPP loan eligibility with. They're not allowable expenses for forgiveness either. So you just have to remember to back those out of the process when you're looking at what is my eligible loan. And do remember for the self-employed individuals, we kind of already talked about a cap of 100,000 compensation for the year. That same cap applies to to those individuals who are in an S corporation or C corporation as well. So the maximum amount of a payroll cost that you include for the loan for any of those folks is $20,833 if you hit that $100,000 level. Okay, so what are some of the other things besides just salary and wages? These include the group health insurance, and now, like I've bolded on here, the other group insurance payments. So this is the vision, dental, life, and disability insurance benefits. Those are all eligible health insurance payments when they're paid by the employer. So it's the employer portion of those that are eligible. The employer retirement plan contributions, your withholdings from your employee pay, and your FICA and FUTA taxes, as well as state and local payroll taxes. Though, one thing to call out here, specifically because many of us are in Washington State that are on this webinar, our Washington State L&I, even though it is a payroll tax by the state, it is still an item of worker compensation, not necessarily based on pay, but based on hours worked. So it's excluded from the definition of payroll costs. So you don't get to include your L&I. You get to include the unemployment portion, but not labor and industries. Because in many states, you don't have a state-run L&I system. You go buy private insurance, workers' compensation insurance. And so that's specifically excluded from what are my eligible payroll costs for figuring out my loan and which ones can I actually use when it comes to filing for forgiveness. Eligible expenses. So, that was talking about payroll costs, right? So what payroll costs do we get to use for figuring out the size of the loan? This specifically talks about how must those PPP loans proceeds be spent, because we have a larger list of expenses than just payroll costs that we can actually spend the money on. Do remember, if you do spend stuff on expenses that aren't eligible expenses, you could be in trouble. One, the loan could become a recourse loan to you, and two, you could honestly be prosecuted from having got ineligible or spent the money inelibly. So make sure if you're getting a PPP loan proceeds, even if it doesn't all get spent on payroll, it gets spent on costs in the eligible category. And they expanded the definition of the eligible category, which we're going to talk about. Do remember, because this is where, and we'll talk about forgiveness in a second, but this is an important thing. No matter what, I don't care if you spent all of your money on eligible expenses. That's great. You're not going to be prosecuted. You spend on eligible expenses. But in order to qualify for full forgiveness of a PPP loan, at least 60% of those proceeds had to have been spent on the payroll costs. So, you can have a loan of $100,000. You have to spend at least 60 grand on payroll to get the full 100,000 forgiven. Now you could most likely, like most of my clients, all of it went to payroll, especially when you're saying, hey, we have 2.5 months worth of payroll costs we're getting a loan for, but we've got 6 months, 24 weeks to spend it. I mean, the situations where we haven't spent all of those proceeds on payroll, from what I've seen with clients so far, are extremely few and far between. So we're going to talk about the list of eligible expenses, but do keep in the back of your mind, unless you're in a very unusual situation with that expanded 24-week period of coverage, the vast majority of expenses got spent on payroll. So what are some of those eligible expenses? It's payroll costs, it's mortgage interest, but mortgage interest, rent and lease payments, there's some very specific rules around those. There's a definition of, they're all eligible expenses to be spent on, but to qualify for forgiveness, you have to have had those contracts in place before February 15, 2020. So you couldn't just go sign up for a new lease after coronavirus hit and use those as forgivable expenses. They're eligible to spend the money on, but not necessarily forgivable. Now, I do expect we're going to have another follow-up webinar sometime on more detailed forgiveness. So I'm not going to spend a ton of time on these, but I want you to have the slide deck available to you to refer back to. Like I said, vast majority of people, it was spent on payroll. So a lot of these things didn't really matter at the end of the day. But for some people, a smaller subset, they did. So it's good to be aware of what those eligible expenses were. Utility payments, transportation payments, that all had that same connotation of did it exist before February 15th or after in terms of forgiveness, all eligible, but who got it forgiven or not. And then the paycheck or the stimulus bill that was just passed added on 4 new categories of expenses. And we'll just hit those very quick. You have covered operating expenses, covered property damage costs, covered worker protection expenditures, and covered supplier costs. And so let's dive into those specifically. Say, what are these new eligible expenses the stimulus package gave us? So covered operational costs, you can see here, it's essentially software and services that facilitated running your business. So including human resources, sale and billing functions, accounting processes, those software and services you spent to keep the business running are now eligible expenses for the business. Covered property damage costs, if you had property damaged or vandalized and related to looting or public disturbance during 2020 that wasn't reimbursed by insurance, now those are eligible costs. Covered supplier costs. So this is if we have a ordinary and necessary supply cost for a business. So say we sell pizzas, right? And all the ingredients that go into our pizza are a very critical part of our business. I.e., if we don't have those ingredients, we don't have a product to sell. If I had orders or an agreement, a contract in place prior to getting my PPP loan, those expenses I paid are deductible as well. And once again, I don't think this is going to be a big issue because you're going to most likely spend the vast majority of funds on payroll costs, but this is a new eligible expense category. And then the final, eligible expense category is these covered worker protection expenditures, which is essentially saying, hey, if I've got an operating or capital expenditure that I incurred for my business, and that capital expenditure is new because most of our programs are saying you couldn't expand a business, you couldn't do new fixed asset additions and use these as eligible expenses. But if that specifically related to something I had to do given a government order around worker safety, customer protection, etc., now I can consider those to be eligible expenses. So think of every drive-through you go through now has a huge plexiglass covering on the drive-through window. Or if you go into a business lobby, there may be the big sneeze guards that are out there. All of those are covered protection equipment. The other example they use is if you installed new air filtration systems so that you get the germs out of the air, that's going to be a covered expense. If you have to pay for PP&E for your workers, those are covered. All of those are now eligible expenses to have used PPP loan funds on. And then finally, let's talk a little bit about the forgiveness application. Like I said, I think as long as the YCDA and Yakima Chamber are okay with another round of webinars and people are interested, we'll probably have a specific webinar on forgiveness, because we actually don't have, the final form here yet. Now, we do have pretty good guidance on what forgiveness processes look like. We've already been having businesses apply for forgiveness, get forgiveness, etc. But part of the stimulus bill did say, Congress directed the SBA to say you have to come up with a simplified forgiveness application for any loans under 150,000. Now, to date, we've had a simplified application. We have 3 different applications that we could use, and one of them kind of meets the qualifications of what they're talking about, but it was only for loans under 50 grand. Congress directed them to say you got to come up with one that's for loans under 150 grand. In the stimulus bill, they gave them 24 days to prepare that form. So guess what? 24 days expires next Wednesday, the 24th. So I expect, unless the SBA is, going to release something sooner, that by next Wednesday, if it's similar to the regulations that came out the night of the due date, we will have a new simplified forgiveness application. Now, to me, it doesn't really change anything. Your application, may be smaller to fill out. Doesn't mean you don't have to go through all the legwork necessary to figure out, do I fully qualify for forgiveness? Because even if you're only filling out a 1-page application that says I spent the money on the allowable costs, you are still certifying that you spent the money on eligible costs and under the terms of the program for forgiveness. So even if you don't have to prove it, you're still certifying it and subject to audit. So I'm telling a client, don't sign that document unless you can prove to yourself that you've spent the money on the way the program was spent. So if you went and got a $140,000 loan and went and bought a boat with it and fired all your employees, don't go fill this out. Government can prosecute you for fraud. If you, got the $140,000 loan, spent it on employees and all the eligible costs, well, just run the numbers to show that you have that in your back pocket in case you ever get audited. But know that you are attesting to the fact that you met the program eligibilities. This is not just a free pass to say any loan under 150,000 is forgiven. It's just a simplified application. You are still saying you followed the rules of the program. So we'll probably have a follow-up webinar on forgiveness specifically, but that's what we know to date on this simplified application. We don't have it yet from the SBA. Now, there has been some changes, and I've got to backtrack on something I said on last week's webinar. And remember, I caveated the hell out of what I said last week. So, here's a place where I was wrong. The covered period. So the stimulus package did enhance the covered period to say, you can select any period between 8 and 24 weeks that you qualify for having spent the money appropriately to apply for forgiveness. However, your covered period still does start on the date of loan disbursement. So, what we were kind of reading into that was maybe we'd be able to select any 8 or 24 week period during 2021 to say we qualify for forgiveness. It's still black and white. Covered period starts the day the loan's dispersed. So that is one area I had to kind of backtrack on what I was saying last week. But yes, covered period starts the day the loan's dispersed. Now, EIDL advanced grants, I talked about this a little bit last week. They clarify, or they change the regulations, say, hey, if you got that advanced grant of anywhere between $1,000 to $10,000, it used to reduce your loan forgiveness. It no longer does. Once again, backtracking on something. Last week I said that's only for people who haven't yet applied for forgiveness. If you receive full forgiveness and you had to reduce it because of an EIDL grant, that you probably were out of luck there, you just lost that money. Scuttlebutt rumor is that they are actually preparing a process to go back and reimburse people who have already applied for forgiveness and got those EIDL advanced grants. So I haven't seen anything to confirm that, but I've heard it from a couple different sources. So I do suspect if you already applied for forgiveness and EIDL advanced grants was part of that, you're probably going to be getting a little bit of money back on that. And then finally, just a reminder and to clarify when forgiveness applications are due. So if a borrower does not apply for forgiveness within 10 months after the last day of your covered period, so that's the 8 or 24 week period that you select after your loan was dispersed, then the loan is no longer deferred and you have to start making payments. Or if the SBA says, hey, you didn't spend it the correct way, you gotta pay us back. But we've essentially got 10 months after our covered period date ended. So, the great example is if you got a loan in April and you're going to elect a 24-week, covered period, which essentially extends out to, around, late September, early October, we have essentially up until July to get the loan forgiveness application into the bank to stop having to repay this loan. So just be aware that's the timeline you're looking at. Last time around, I was saying I thought it started with the date of disbursement for the 10 months. It's actually the date the covered period ends. So it gives us a little bit more time to look at the loan forgiveness process itself. And so with that, it's 10:08. If everybody could just give me 2 or 3 minutes to look through the questionnaire real quick, the questions have been answered. I'm going to just kind of sort out my thoughts and be back, in 2 minutes to spend the last 20 minutes of this presentation going through some of the questions and answers. So if you still have questions that have been unanswered, feel free to ask them now. I want to spend this time going through those. If you think this covered it all, this last 20 minutes is just going to be a question and answer. So feel free to drop off too. So I'll be back in 2 minutes. All right, it's 10:10, and I've been able to look through the list of questions, and there's some really good ones. So I'm just going to start going down the list and answering these. If there's things that are duplicate, I'll skip over them. I am also aware. Jess and I will probably work together at Yakima Economic Council, and I'll put together kind of a follow-up response on some of these as well. So if you miss some of these, we'll probably have a written response coming out. But I do want to take the time to answer these questions to see if it then generates any further responses, right? And so looking at the questions that have come up so far, if you're a first-time borrower, is the necessity rules related to the first-time application sector? The necessity rules haven't changed. You have to still certify that the loan is necessary. Now, like I said, the safe harbor that exists for loans under 2 million, the SBA clearly called out in the guidance, still exists for the second draw loans as well. But that necessity certification hasn't changed. It's just the qualifying factors of second draw versus first draw have changed, but that necessity question is still the exact same. In terms of loss of income, I think this is hopefully answered during it, but it is any one quarter in 2020 compared to the same quarter in 19. It's not all quarters. So it's just any one quarter that qualifies. Define operational around, like my example of a client who started business on 218. This is a challenging one because the banks, from what I've seen, have been very, very clear cut on that, which is saying, hey, I don't see a business license that existed or a federal EIN that existed before, February 15th. We're not going to say you're an eligible borrower. So maybe you can work with your bank if you've got a situation where, hey, state of Washington delayed getting my license, but I can clearly show, costs that were being incurred and things I was doing prior to 215. It's worth a shot, but I'm just not sure you're going to be able to get through with the bank, because what I've seen is they're very specifically defining, did you have a bank account or did you have a business license that existed prior to that 215 date? So yeah, there's no great definition of operational. That's been kind of left to the banks, and that's what I've seen so far. In terms of expenses allowed on a first draw as part of your loan forgiveness. So if you have not yet applied for first round loan forgiveness, these new eligible expense criteria that we called out are you're eligible for your first round forgiveness. So these new 4 categories of expenses, the new payroll costs for group insurance that they added in, those are all eligible expenses that if you haven't applied for forgiveness yet, you can include in that forgiveness application. Now, what if you're a borrower who applied for forgiveness already, received it, and maybe you had forgiveness reduction because you didn't meet the full 100% criteria? Right now, what we know is you're kind of out of luck, but that doesn't mean don't stay tuned, because there's the potential that the SBA could issue new guidance on that. We just haven't seen it yet. Right now, what we know is you probably can't go back and change that forgiveness application if it's already been to the SBA, but who knows, maybe there'll be new guidance issued. Question about investment income. The question specifically talks about a nonprofit having investment income, but really it applies to anybody. From the definition of gross receipts, investment income is income for the business, for the nonprofit. So investment income goes into your gross receipts calculation. Same thing, I've had this question from a lot of my farm clients. What about the farm program support payments that came through, CFAP, all the different CFAP programs? Clearly, from this guidance, those are income. So those are not excludable from your calculations, which for my farm clients means that they may not qualify for these second round PPP loans. I've probably seen about 50-50 on my farm clients, even though commodity prices may not have been strong, and especially like if you were a dairy farm and schools were shut down and the milk was prices were dropping like nothing else, because CFAP is still income. You may very well not find any quarters where you had a 25% reduction in gross receipts. 1099 wages still, 1099, not employee compensation. If you are paying contractors on a 1099, that is not part of your payroll costs. Do not include those because they are not allowable payroll costs. Now, this was where the wild west occurred, back in April, and some banks let those go through. So I have a handful of clients that got PPP loans based on 1099 costs for independent contractors. But what we're facing now is they didn't have the payroll to support that. And so they're actually having to repay portions of their loan. So, even if your bank let those go through, they're not eligible payroll costs. It's specifically called out in the guidance, because those folks are able to go apply for their own PPP loan. In terms of grant money from, say, YCDA or any other program, it's not specifically excluded. It was very clearly defined what was excluded. So, my counsel to clients would be, if you receive grant money from a state grant type program, it's probably includable in that gross receipts. Good question. I've had a couple of these about PEO organizations. So PEO organizations are potentially, professional payroll providing, so if you work with a third-party payroll service and they're technically the employer of record, even though you're the actual employer, all your wages get reported on their, payroll reports, whether the 941s, et cetera. Those organizations, that still counts as you, the employer's payroll. And so the SBA put out very specific PEO type guidance to say, okay, if you use a PEO and you don't necessarily have a 941, here's the information you can get from the PEO to substantiate your payroll expenses. So just because you use a PEO doesn't mean you're not eligible for these programs. You just have to work with PEO to get the right information from them to be able to substantiate the payroll costs to the bank and to the SBA. Question about private clubs. Do they include country clubs? I haven't seen one way or the other. My guess is, when they say private clubs, they're saying your membership is based on a certain criteria. That's who can use it. So I would probably argue a country club probably is going to fall into that private club. I haven't seen that for sure, but that would be my take on the whole situations. Oh, great question. So let's say 2020 is what you're going to be basing your payroll cost calculations on, and you actually had, of course, you got first round PPP loan funds, and now you're applying for second round funds. Can you use those PPP loan funds that were paid with, the first round PPP loan funds in the calculation for your second round? Well, since the SBA didn't specifically call out guidance saying you couldn't, my argument is yes, you can. Now, could that change? Who knows? But right now, there's no guidance to say that those, 2020 payroll expenses paid with PPP loan funds aren't eligible as expenses to calculate your second round draws with. Let's see here. Submit for, sorry, there's more questions coming in, so I'm just trying to look at them. Here's a great question. Do you have to get your second draw PPP loan from the same bank you got the first one from? No, you can work with a different bank. No restrictions on that. It's just the amount of documents you're going to have to submit to the new lender. You have to basically go back and submit all the payroll substantiation documents, the revenue reduction substantiation documents. You don't get to transfer that information between lenders. So if you choose to work with a different lender for the second draw loans, you're definitely able to. You just have to use, those. You're just going to have to resubmit all that information. If we use a temp service to hire all employees, what data can we use for figuring out average payroll costs? Now, that's a challenging one. This is going to go back to, is that temp service kind of under that PEO umbrella, and those are actually your employees, or are these just contractors you're paying? So if they're contractors you're paying, it's not eligible payroll costs. Eligible payroll costs are your actual employees. Resources for first-time borrowers. So if you go look at when you get the slide decks, and actually I'll just bring it up right now. We have an appendix here. There is guidance from various sources, the SBA, the U.S. Department of Treasury. Those definitely have really good guidance about the application process. I would tell you, if you're going to be a first-time borrower, a lot of what we talked about today, applies, other than, you get a much larger employee limit. You're at 500 instead of 300, and you don't have to worry about the reduction in gross receipts test. Other than that, the eligibility requirements are the same. The payroll cost calculations are the same. You can go in and apply. And when I'm talking to my client base in the last week, it's a 50-50 split. About 50% of my conversations are focused on, are you an eligible second round borrower? The other 50% is on, if you didn't go get a first round PPP loan because you didn't like the uncertainty of the program, you're still eligible to go get this. And so I expect that you're going to have a pretty even split of borrowers on this new program. Fees paid to a PEO or payroll provider as eligible expenses. Yes, those fall into the services. So I kind of said that covered operations with software and service costs. So any service costs you're spending on accounting, payroll, etc., those are now eligible costs. So I have some questions on seasonal FTE employees counted. I think we kind of went through that on the slide deck in terms of how you qualify out them on average payroll costs. H2A guys, H2A does not come into the payroll cost considerations. So H-2A is not considered payroll cost because they don't fall into that definition of primary residence in the US. So, for some of my, larger farm clients who rely on H-2A labor, there's a big difference between what was their eligible payroll costs and what are their total payroll costs, because the H-2A workers don't go into that eligible payroll cost. Oh, great question about a restaurant. Somebody in that NAICS code 72 arena we talked about. So if you were an eligible NAICS code 72 borrower who didn't get a first round PPP loan, and now you're going to go after that, you get to use the 3.5 times average payroll cost, not the 2.5 times. So you get the larger of those, whether you're a first round borrower or a second round borrower. For a seasonal employer rule. So great question. I have 100 employees that are here for 4 or 5 months out of the year, and then I have 5 year-round employees, right? It's not the length of the employee time that counts into your, if I'm a seasonal employer or not. It's going back to that, test of how many months of operation am I in, and how many months do I actually earn the vast majority of my gross receipts. If you fall into either one of those two categories to define you as a seasonal employer, then you're eligible to use that specific 12-week period that fits best into your operations for figuring out average payroll costs. So it doesn't matter that you have 5 guys who work year round. If you're a seasonal employer by those receipt definitions, then you can just pick a 12-week period when you had that 100 people working to figure out what your average payroll costs are. Requirements about FTE, same as round 1. I think we've kind of gone through that. So FTEs, first round 500 or less, second round 300 or less. The way you figure out those FTEs is still the exact same. What quarter would you include CFAP funds? That's great question. So this goes back to the cash versus accrual method. If you're recognizing revenue on an accrual basis, you may have allocated CFAP over a course of time, depending on how you read accrued revenue had to be recorded. But when you flip around and look at it from cash basis, you only got those CFAP funds in one specific month. So it's just that specific quarter they apply to under a cash basis. Option to include owner or partner compensation separate from the application. No, it's just part of, the applications themselves are really like 2 pages long. 1 page of put in your total amount of payroll costs and then sign a bunch of certifications and you're done. And so, you're just going to be including your owner compensation payroll cost on the application in totality with the rest of the employees. Now, you're going to still have to provide documentation to the bank to substantiate those payroll costs, right? So, I did a PPP loan application for a nonprofit that I'm on the board of. I filled out the application saying, hey, our payroll costs are $256,000 for, the average monthly payroll cost, right? I still had to provide a whole host of supporting details around 941s, payroll reports to show how I got there. And so, if you're filling out these applications for the owner compensation replacement, you're going to be doing the same thing. You're going to be including it in the total on the application, but then providing the supporting details to say, okay, how did I get to average payroll cost for employees? How did I get to that owner's compensation replacement amount? And that's what's going into that total number on my application. I still have to provide the support for it though. Question about affiliation rules for PPP second round loans. Yes, same affiliation rules that were under the first round loans apply to the second round loans. Those affiliation rules are very complex. So those are things that if you're going to fall into those, it's good to talk to your CPA or your lawyer about those because they're complex rules. Question around partners in a subchapter S, do they have to be actual employees to qualify as payroll expenses? Yeah, your distributions you take as a subchapter S are not qualified payroll expenses. Qualified payroll expenses or owner compensation expenses are things that you're paying Social Security and Medicare tax on. And so if you're taking distributions on top of your wages out of the S corp, it's only your wages that qualify. It's not the distributions. It's the same thing on a partnership. I could have prior capital in my partnership, means I can take more distributions than the business profits I earned. That doesn't mean those get to account for my payroll costs. It's back to what I'm paying, FICA taxes on. Let me look through the list. Oh yeah, if you qualified as a seasonal employer, that's definitely an area, especially if you got the loan early on. You're going to want to go back and look at your average payroll cost calculations and say, okay, under the new rules that are issued after I got that original loan, could I have potentially qualified for a higher loan? And really, this goes back to that discussion around, am I going to be an eligible second round borrower? Do I get a first round increase? Which one do I potentially want to go after? You might be able to go after both, but I'm somewhat counseling my clients, pick whichever one's going to be the better bet for you. But you should be looking at, what, if I'm falling into one of those categories that I list on the slides about, potential cases where you could qualify for an increase in a first round loan, it's time to go back and look at those rules and figure out how much I might be eligible for. I guess from Jess, from your guys' side, is there any questions you've seen that I haven't responded to? Oh, I did see one that I skipped over. I wanted to get back to. The owner compensation, is that considered part of that 60% of payroll costs? Yes, it is. So when you're looking at the forgiveness application, the amount that we're using as owner's compensation is considered payroll costs. So that's a forgivable part of that, minimum threshold you have to get to of 60% for full forgiveness. And for a self-employed individual, it's actually kind of almost a slam dunk in terms of the forgiveness, because you're going back to say, I'm basing, this loan amount on my 2019 compensation calculated based on my business profits, and that's what my forgiveness is predicated on too. So I'm essentially going to be getting that part forgiven, but yes, it is part of that eligible payroll costs. Sorry, Jess, did you see any other questions I haven't answered that, in the minute remaining we should touch upon?
Yeah, so Jonathan sent me a question here from someone who sent him one. It says, on the first draw, we were originally covered for the 8 weeks because they had not approved the 24 weeks regarding forgiveness.
Yep.
Period 8 or 24 weeks.
So as long as you haven't applied for forgiveness yet, even if you got the loans early on when it was still just an 8-week period, as soon as they released the guidance saying you had 24 weeks, then you're eligible to use a 24-week period. So the only people who may be stuck with an 8-week period is those who used it within 8 weeks and then filed the forgiveness application already to use the 8 weeks. If you haven't filed a forgiveness application, the full 24-week period is available to you.
Perfect. So we do have more coming in. I see that here. So we will send you a list, Brian, and that way you can look over some of these questions and we can get some answers from you. And then we will send these questions and answers back to everyone who attended the webinar, along with a link to a YouTube link so that they can rewatch the webinar if they need to. So.
All right. I did see one really critical question come in, so I'm just going to answer it. The second round loans, we have the ability to use anywhere between an 8 and 24 week period. So people are wondering about that. It's anywhere between 8 and 24 weeks that you have on the second draw loans.
Okay. All right.
Okay. Well, Brian, thanks again. I think we'll be probably scheduling some more of these with you. We truly appreciate you doing this and Alegria allowing you to give us your time, and we really truly are grateful. I'd like to thank everybody that attended, and we'll be letting you know. We'll try to get Brian scheduled for another one. This is really important information. I know I'm getting a lot of calls and a lot of emails about it, so we really truly are grateful. So thanks everybody for attending today on behalf of Jonathan Smith from YCBA and his staff and myself here at the Greater Yakima Chamber of Commerce. Thank you.
Thank you all. Bye.